All right, so we're moving on here, still talking about itemized deductions, those from AGI deductions. Next one is deductible interest expense. Remember, if you can kind of picture that, Schedule A in your mind, or you can pull it up if you want to take a look at it. We've got each of these learning objectives. We're going in order on that form. So now we're on the third section of that form, deductible interest. The biggest chunk of deductible interest is usually related to mortgage interest. So if you buy a house and you borrow to pay for that house, the interest that you pay every year on that loan could be deductible. Now, obviously, again, we've got to get over that hurdle of a total of our itemized deductions have to be greater than our standard deductions, so that's our first hurdle there. We do have some qualifications as well with regard to this particular deduction. It used to be that your car loan and your credit cards were actually, the interest on those were actually deductible. That's way before my time. I've never experienced that, but that's not the case anymore. It's only that mortgage interest. Additionally, in this category is investment interest, and we'll talk a little bit about that. So this is for your personal residence. So it could be a townhome, it could be a single family home, it could be a condo, but this is the place where you reside, your primary residence, and you're allowed to take the interest expense on if you're lucky enough to have one additional residence. There's Kelsey. Then you can take the interest deduction on any loans that are taken out against that home as well, but you're limited to 2. So if you're lucky enough to have 3 or 4 or 5 or 7 homes, sorry, only the first 2. If you have loans on those, would qualify. Any type of property that's owned by a business or rental property, that's also pretty common where you would borrow to purchase a rental property. That or farm loans as well, even if it's if it's part of a farm, those would go on separate schedules. Okay, so we're only talking about personal residences here. This is one of those rare areas in the tax code where you actually get a deduction for some personal expenses. Most personal expenses are not deductible, but home mortgage interest is deductible. Go pass over this stuff here. So, oh, that's the state and local taxes. What are we doing here? Okay, so first off, the interest has to be paid on a loan that is for acquisition indebtedness or home equity loan secured by a qualified residence. So, oftentimes individuals will have more than one loan on their property. If they've got equity, they'll borrow against that equity, maybe to make some improvements on their property. That is deductible interest as long as it is used solely for the purpose of improving the property. If you take out a home equity loan and you use it to pay off credit card debt, then any interest paid toward that would not be considered deductible, because that's really just a workaround, right? So it only pertains to loans taken out for a qualified residence. So, and what they talk about acquisition indebtedness here, this is any debt incurred to acquire, purchase, construct, build, or substantially improve any qualified residence. So if you take out a loan you take out a home equity loan and you need, I don't know, I just had to replace our driveway. Which is exactly what I want to spend money on, is a driveway. Somebody was walking down, they complained about our sidewalk, which was just slightly off and just did the whole driveway. Anyway, take out a loan to improve the driveway, to fix the driveway, then that is interest for substantially improving the qualified residence, okay? Essentially anything that's going to improve that asset value, right? Or maintain that asset value as well. but not like regular maintenance. So, try to think of an example. So let's say you have a plumbing mishap. You have a broken water pipe and you have to get it fixed. Well, you take out a loan to get that fixed. That's not really to improve the house. That's just to maintain it and keep it at its value. Okay, so you can deduct that interest on your principal residence and on a second residence. You can choose which second residence. So if you do have 7 houses, you can pick and choose which ones of the house. Well, your primary residence you don't get to pick and choose. That's the one that's your primary place of abode. That's where you consider your home. But on second residence, you can pick and choose amongst those other 6 homes. Now, there are limits on, not necessarily on the interest itself, but on the amount of debt. So, the maximum amount of indebtedness cannot exceed $750,000 in total. So if you buy a house for $1 million and you take out a loan for $800,000, $50,000 of that loan, you cannot claim the interest on that additional $50,000. Okay, so it has to do with the limit on the amount of debt that you have, not the interest itself. So, I mean, depending on, interest rates are getting ridiculous now. So that's, a few years ago you could get a loan mortgage for 2-3%. Now it's more like 8% on the same amount of debt. So it's the limit is on the amount of debt, not on the amount of interest that is paid. And that is in total, $750,000 in total for all of the properties combined. What else do I want to say? Let's see. Taxpayers can have more than one loan per residence. So first and second mortgage, I talked about those home equity loans and that. There are some exceptions. So it used to be $1 million, and then they changed it to $750,000. But there is some phase-in for when to take into account homes that were purchased before that change. Okay. So when that happens, you have to, and you're not going to have any problems around this, but I just, from my own experience, when that happens, then you have to fill out a separate schedule to calculate the actual amount of interest that can be claimed on that. Okay. And that's this IRS, the worksheet. So we got an example here, Katrina and Marcus. They're married, incurred debt of $580,000 to build their new personal residence. In the following year, they decide to build a vacation home at the beach and borrow an additional $200,000 to build it. Well, 580 plus 200,000 is over 750,000, right? Their acquisition indebtedness is limited to $750,000. So the additional 30,000. The interest on the additional 30,000 would not be deductible to them, okay? And you'd have to do that calculation. Let's see. What else do I want to say about this? So this mortgage interest deduction debt limit applies to unmarried co-owners on a per taxpayer basis. This means that if you own, so you've got you're a married couple, your limit is $750,000 as a married couple. Yeah.
Does it matter if they pay off some of the debt?
So does it change the mortgage indebtedness? It has to do with the principal amount. So if that principal comes down, yeah,
Oh.
then it changes the calculation. Yep, absolutely. Great question, by the way. So it is applied on a per taxpayer basis. So if you have a married couple that together own a home with $800,000 of mortgage indebtedness, well, they're $50,000 over. They're considered one taxpayer. So and as it says here, so whereas a married couple filing jointly is seen as effectively being one taxpayer, So they are subject to the overall mortgage interest deduction limit of $750,000. However, if it's an unmarried couple that own a home together, they each get that $750,000, which essentially makes it $1.5 million. Kind of a marriage penalty there, sort of like with the student loan interest, where it's per, it's $2,500 even if both of you have a student loan. It's not on a per individual basis, it's on a per tax return basis. So in this case, those who are not married actually get more of a benefit if they own property together and their mortgage interest indebtedness is over that $750,000. Talked a little bit about home equity. If you use that loan to improve the property, then the interest is deductible. If you use it for other purposes, buying a car, paying for education, paying off credit card debts, then it is not deductible for the mortgage interest deduction. Let's see. The loan, loan has to be secured by the property. That means that the bank can take property if you, and I mean most mortgages are that way, right? If you don't make the payments. Let's see, what else do I want to say here? So we'll look at this example here. Brian purchased a house several years ago for $130,000. The acquisition debt still outstanding, so there you go, still outstanding is $115,000. House's fair market value is now $150,000. The net equity in his house is now $35,000. He decides he's going to borrow against that as a home equity indebtedness. So he can borrow up to $35,000. The interest would be deductible as long as he stays under the $750,000 mark, and as long as the funds were used to substantially improve the residence. So they make a note here that usually you can't borrow 100% of the value of those homes. Okay, mortgage points. For those who aren't familiar, oftentimes what happens when you get a home is, so you lock in an interest rate. But you can oftentimes have the ability to lower that interest rate if you pay a certain amount up front. So for example, let's say you get an interest rate of 6% on your home loan. Say that the building, I have no home. So you buy a house for purchase price is $100,000, and you get a mortgage of 8%. I say 8, I'll say 6. We'll be optimistic, 6%. Okay? But the mortgage company says, hey, if you want, we can reduce this to 5.5% if you pay some of it up front. Okay? So we reduce it to 5.5%, but we have to pay maybe 1% of our total loan. Well, we'll say this is the loan, not the purchase price. So 1% of that. So we pay $1,000 up front now to reduce that interest rate. If you're going to own the home for a long time, if you're planning on owning it for a long time, it might make financial sense to do that, right? Because you're going to be paying every year 5.5% or 0.5% less than what you would have, but you're at the $1,000 right now. So time value of money, that $1,000 is worth more now than you'd have to do the calculation to determine whether it's worth it or not. Usually I think the break even is somewhere around, well, it depends on the reduction, but somewhere around 7 years or so. It's not worth it if you're planning on living there less than that. But anyway, what this is considered, these are points. Oh, squeaky. It's considered to be prepaid interest, right? Because if you had taken the 6%, you would get a deduction for that interest, right? All you're doing here is you're paying up front some of that interest. So those are called points. They call them points because it's usually based on a percentage of the loan value. If it's a flat fee, it's not a point and it's not deductible. It has to be based on a percentage of the loan value in order for that to be the case. And this usually happens so when you purchase a house. Sometimes when you refinance as well, and refinancing is when you take out a new loan. So let's say you got 6% was your original mortgage and interest rates go down to 3%. Well, you want to take advantage of that reduction, so you refinance the home to lower your monthly rates. But usually this is when you purchase a house, you'll pay points. And the bank usually tells you, you get a form at the end of the year that reports the amount of mortgage interest that you paid during the year, and most times those points will be reported as well on that same form. Okay, sometimes they're not. So when you're a tax preparer and somebody buys a home, we always ask for what are called the settlement statement. So it's kind of, it outlines all of the details of the purchase, because that information will be listed on that settlement statement. Let's see, yeah, and they talk about here, the uniform settlement statement. In order for those points to be counted, it has to say that it's their loan origination fees, loan discount points, or points payable in connection with the loan. It has to be computed as a percentage of the principal amount of the loan. And what else here? Amounts must be paid directly by the taxpayer, so you can't have, if the seller pays the points on your behalf, then you don't get a deduction for it. Like if they, to entice you to buy it, they say, hey, we'll pay those points for you. Yes, and all that. So here's an example. Jason and his spouse purchased a home 2007 for $230,000. They borrowed $184,000 with a 30-year 5.5% note. In 2022, they decided to make an addition to the house that would cost $75,000. They borrowed $75,000. When they did that, they paid a 1% loan origination fee. So $750 they paid when they took out that loan. The $750 could be deducted as long as it was in connection with the improvement of their principal residence. So in that case, it was a home equity loan or a home equity line of credit. So here, same facts. Instead of the $75,000 addition, they decided to refinance their loan. Balance now at $175,000 because the interest rate was now 3.75%. The 1% origination fee cannot be fully deducted in that year because the new loan was not for the original purchase price. What you have to do is amortize the amount over the life of the loan. So when it's a refinance, you have to amortize it over the life of the loan. So if it's a 20-year loan, you amortize it over 20 years. 15-year loan, amortize it over 15 years. And what happens then if you sell the home before the amortization period has ended, in the last year you take the rest of the deduction for those points. Let's see. Used to be, so mortgage insurance, go ahead.
Before you continue, that last portion that you were just talking about, the amortization portion. So what do you mean you take the rest of it if you were to sell?
Okay, so if you, we'll use this example here. So the $750, what they did, so they have $750 of points, but they refinanced. So the $750 of points, we're gonna divide it by the number of years, right, in order to amortize it. So $58 a year. That's the amount of their deduction for those points. Let's say they, after 10 years of taking this deduction, so they've taken $580 of that $750, but after the 10th year they decide to sell. That means the rest of that, so $750 minus $580, what they've already taken, they'll get a deduction for that amount. So 1, $170. Do I have that right? 6, yeah.
So the deduction the year that they sell would be the 170 instead of the 58.
Rather than the 58.
Got it.
Yep. Yep, so they get to take, the remainder of it. Great question, by the way. Mortgage insurance. So mortgage insurance is an insurance that it doesn't protect the borrower, it protects the lender. And it's insurance that the borrower pays the insurance, but in the case if the borrower defaults on the loan, the insurance then pays the lender for the value of the remaining debt. But the borrower has to pay that premium, even though they don't get any benefit with regard to payments. But they do that when, oftentimes, if the loan is more than 80% of the value of the property. So, for example, again, if you take out a loan, say you got the property value is $200,000. The loan is for $190,000. Well, $200,000, if 80% of $200,000 is $160,000. So they've only put $10,000 down. In order to get under 80%, they should have put $40,000 down, but they weren't able to. They didn't have the funds to put down a $40,000 down payment. So what the mortgage company does, because now the homeowner doesn't have as much skin in the game when it's $10,000 as opposed to if it's $40,000. So they're a higher risk to the lender. So the lender requires them to purchase mortgage insurance. So if they default on the mortgage, then the lender will get paid, right? They'll get their money back. It's for it's for the lender, not the mortgagee. There was, and I've gone all through this to tell you that this deduction doesn't exist anymore. There was a deduction for the premiums every month until 2022. So, and there were limits on how much your AGI was as to whether or not you received that. Oftentimes, like mortgage insurance would usually run, depending, maybe for $200,000, maybe $1,000 a year. And so that $1,000 would have been deductible as long as you met those AGI limitations. But that no longer exists. Okay. So that was a long-winded way of saying you don't have to worry about that. Don't listen to any of that. No. Just a little extra for you. No extra charge. Freebie. Okay, so that's mortgage interest. Questions about mortgage interest? All right, so another type of interest that can be deductible if taxpayers itemize their deductions is investment interest. This is when a taxpayer borrows money in order to make an investment. Like I said, there are those that will borrow to buy stocks and bonds, which probably isn't real advisable, but people do it. It's called margin interest. And it would be deductible up to certain limits. Also, people will buy land. So that's a little bit less risky to borrow in order to purchase land because you've got a hard asset at the end of it, right? So any interest that is paid or accrued on indebtedness, properly allocable, these words, to property held for investment, okay? It is limited though, of course it's limited. They're not just gonna give it to you, right? It is limited to the amount of investment income that the taxpayer receives in that year. So, for example, the investment income doesn't have to have anything to do with this particular investment. So let's say we had interest income of $300, we had dividends of $300, and we had some capital gains of $1,000. So our total investment income was $1,600, okay? Again, this is investment income. But we have this piece of land that we purchased that's not bringing in any money to us yet, but we're paying interest on it. Investment interest of $2,000 that we paid. We're limited to $1,600. So you cannot, it can only zero out the investment income, it can't take you below the investment income. Okay, so that's the limitation. That make sense? Yes? No? Here's an example. Gail purchased land. She bought it because she thought it would appreciate over the next several years. She borrowed $20,000 from the bank, signed a 5% 15-year note. If her only investment income is interest of $1,000, she could deduct the interest on the lending institution loan up to $1,000. Okay, even though at 5% on $20,000, what is that, well, that's $1,000 in the first year, but any remaining amount of interest would be carried forward to future years and would be deducted when additional net investment income becomes available. This is a new concept for us, but this is very common in the tax code. So they're not saying, okay, you never get to take this. What they're saying is this additional, so in this case, our $400 we'll carry it forward to next year. So then we'll look at 2023, and if we have, let's say we don't have any investment interest in 2023, but again we have $1,600, so this is 2022, but we have $1,600 of investment income, but we don't have any, maybe we sold that land or something. That's what our capital gain came from. We can carry forward this $400 from last year and only have to pay tax on $1,200. But again, only if we itemize our deductions. We might not itemize our deductions, in which case we don't get that. You're gonna see this carry forward concept a lot especially in chapter 7, when we start talking about capital gains and other types of gains. Okay, you can't use it this year because you don't have enough to offset it, but you can carry it forward to a new year. Sometimes they're carry backs, so you can go back and file this. In this case, it's not a carry back, but there are certain instances where you can carry back to like 3 years ago. You'd have to file an amended return, but then you get a benefit and you can get the refund or what have you. Okay, but that shows up. That concept shows up a lot in tax. The carry forward, carry back, that sort of thing. So what is included is investment income, interest income, dividends, ordinary dividends. So not qualified dividends because of the reduced tax rate. Short-term capital gains as well. There is a netting procedure as well with that, as they talk about here. Gains and losses have to be netted together. So you don't have to get too much into the weeds on that, but when we get to chapter 7, we are going to be doing some netting of gains and losses. Your heads might explode, so just kind of fair warning there. What else? Is there anything else here? Oh, so this is what the mortgage interest statement looks like. It's a 1098. So you can see the bank would, or the lender would indicate how much mortgage interest was received during a year. So that's the deductible amount. It might have information about the mortgage principal, the origination date. So this would be important if we're close to that, if we're close to that $750,000 mark, right? Oh, come on. Oh, there we go. Mortgage insurance premiums, so those aren't deductible anymore, but it would be there. Points paid on the purchase of principal residence, if those were reported by the lending institution, they would be there. Oftentimes you'll have a description of the property, especially if you've got multiple properties. And especially like, I would have clients that have multiple like rental properties. Or maybe it's an apartment complex or, and they've got different units, but they've got mortgages all over the place, or they've got like 4 houses. It's very helpful to have that address there, if you're trying to keep straight all of that. And we'll get to that stuff in chapter 8. Let's see. Anything else here? I don't know why they put this in here, but there is an additional tax called a net investment income tax. For AGIs that are over certain thresholds, I think it's like 250,000. It's an additional 3.8% Medicare tax for higher income, but we don't really need to worry about that in this section. Questions? Yeah.
With the $400 carry forward, so that decreases the investment income,
The next year.
but wouldn't you want the income to be higher?
Well, in order to use it, if you don't have the investment income, then it just keeps carrying forward until you do have the investment income. Yeah, I mean, you'd want to be able to absorb it, but,
So is that what you can deduct then?
so the 400 would be on so this would be on the 1040 here on page 1, right? All of that investment income. This would show up on the Schedule A here. I don't think I'm answering your question though.
So you deduct the 400 or?
The following year, you get to deduct it. You carry it forward to the next year.
Okay, so you don't necessarily need the income to be higher, you're just deducting it.
You still have to have enough income. So, for example, if this was 300, now we can only use 300 of this to get our net tax on that to 0. We're gonna carry forward again 100 to 2024.
Is there a limit to how
I don't
long
think
you
there
can
is
carry
with,
over?
I don't think there is with this particular one. But there are other ones that do have like limits, like 20 years or something, or some of them are 3 years, where you can only carry it forward for a certain amount of time.
Okay.
And then you just lose it. Does that answer your question?
I think so.
Okay. We'll get more, don't get too much into the weeds on that carry forward concept. That's just kind of a little preview, but we will in chapter 7, we'll be talking about that with regard to capital gains and losses. Okay?
As far as the top of the screen, if you were to scroll up a little bit, no, too far. It was that first line. So, okay, so, and the reason you take out the qualified dividends is because they're taxed at their own rate, right?
Yeah.
Okay. Is that the qualified dividends percentage the same, like, just across the board?
The tax rate?
Mm-hmm.
Yes, but I mean, depending upon adjusted gross income.
Okay.
Yeah. Okay. And this is talking about whether or not you have to file a certain tax form with it, form 4952. Again, so
Oh, okay.
yeah, the 4952 is used to calculate the report and report the amount of deductible investment interest. Whoops. However, you do not have to fill it out if all of these circumstances apply. So, and then they've got this stuff in the middle here. So,
Okay.
yeah. Other questions?